The Reserve Bank of India's Monetary Policy Committee sprang a surprise on Thursday. Contrary to wider expectation that the repo rate will be increased by 25 basis points or 0.25%, the Reserve Bank of India decided to leave the interest rate on hold at 6.50%. Now, repo rate is the benchmark interest rate at which the Reserve Bank lends money to commercial banks. As the repo rate increases, the cost of borrowing of commercial banks goes up. This in turn is passed on by commercial banks to borrowers in the form of higher interest rates on the loans that they have taken. In the last 12 months, the repo rate has gone up from 4% to 6.5%. This has had a bearing on other loans. Look at home loans, for instance. That interest rate has gone up from around 6.5% 12 months ago to around 9% now. Why has RBI chosen to keep interest rates on hold this time around? Well, one key reason that RBI has cited is the global turmoil in financial markets. In the US, at least 2 regional commercial banks have collapsed in March. In Europe, regulators sold Credit Suisse to UBS hastily to avoid the contagion from spreading. Now, Indian banking system is healthy and resilient, but in an increasingly interconnected world, we are not immune to global shocks, and RBI is clearly watchful of what's happening in the global financial world. Second, and perhaps a major reason behind RBI's decision to hold interest rates right now is inflation. Now, for quite some time, inflation has been trending well above RBI's targeted 2 to 6% range. In February, the inflation was at 6.44%. That's well above the RBI's target as well. But it is expecting that this inflation will come down in the coming months. For the current financial year, that is 2023-2024, RBI's projection is that inflation will be at 5.2%. In the April-June quarter, it is expecting that the inflation will be at 5.1%. So if this CPI inflation trajectory is as per what RBI is expecting, then obviously there will be no further need to raise repo rates in the current financial year, say analysts. But there are several things that need to be considered. There have been unseasonal rains in many parts of the country in the month of March. Economists say this will have an impact on agricultural produce. Now, this year there are also expectations of El Nino conditions. This may impact the monsoon rains, and if that happens, then your rural economy has an impact. The oil producing countries recently have announced a cut in oil production. This will drive prices of crude oil higher. For a country like India, which is dependent on crude oil imports, this will be a major impact and will bite. Core inflation anyways has been trending stickily at around 6% for quite some time now. So that is another major concern of how it can be brought down. RBI has clearly left a room when it said today clearly that today's decision to hold interest rates was a pause and not necessarily a pivot. So if a need arises in the future, maybe few months down the line, that interest rates need to be increased because of sticky inflation, if inflation remains well above the target, then RBI will still have the room to do so. But if the inflation falls to within RBI's targeted band, and as it is projecting it will, then obviously the rates will be on hold for a longer period of time. The hope will be that interest rates will be on hold for a longer period of time. This will increase your credit offtake, and this will also reduce the burden on existing home loan owners who have seen that EMIs increase month on month and now are hoping that there will be a pause at some point of time.